So Garda Capital Group, listed tomorrow. What are we? Integrated real estate business comprising funds management, debt advisory and property investment. The objective of the group is to sustainably grow as that integrated real estate business, provide a higher returns and growth prospects than a traditional REIT or a funds management business, and provide sustainable growing distributable income streams derived from both operational as well as investment returns. The capital raising was about $16 million, $9.5, $10 million. That was major shareholders converting debt to equity, and a $6.5 million capital raising thereafter. $2.5 million was cornerstoned to a Brisbane-based investor, and $4 million was then available across to new investors. Looking forward, the Garda Capital Group has been restructured as a stapled entity, one unit in the Garda Capital Trust stable to one share in the Garda Capital Limited Group, providing us with a tax-efficient structure for our business plan. Trust distributions to be made from investment operations, investment activities, whilst company dividends provided out of the operating activities. Distributions from the business out of the trust side we expect to be made on a quarterly basis, and franked dividends on a half-yearly basis. Tax deferred of about 30% on those trust distributions looking forward. The business model, what are we? As we say, diversified property investment returns complemented by corporate earnings from that established funds management, debt advisory activities. The four things that we do: we're a fund manager, equity co-investor, property debt advisor, and real estate debt investment. In terms of funds management, we are the external manager of Garda Diversified Fund, the vehicle that we listed about this time last year, GDF. We are also the largest major investor in that vehicle, with about 11% stake in GDF. Property debt advisory, fee for service. We're a intermediary that arranges commercial real estate debt, $200 million a year for third-party borrowers. Also provides us with a pipeline for proprietary lending activities. That leads us to our fourth activity, which is we're very happy to invest into real estate through debt positions in the same way we are to take equity positions. All four of those things basically provide us with synergies across the entirety of the business. Importantly, the existing platform provides leverage with capacity to significantly increase the assets under management in GDF without additional expense. The business has been operating for a number of years, and there's a lot of existing overhead in place that allows us to grow without further cost. To take that a step further, for every $100 million in AUM growth in GDF generates about another $1 million in revenue. The first $100 million of AUM growth, we don't expect any increased costs having regard for the existing business space. Since we started marketing the float some time ago, we've increased AUM and GDF by about 10%, and there's acquisition capability up to about 30%, quite comfortably within our gearing constraints. Debt advisory and debt investment. Current credit constrained environments providing greater advisory needs, and also providing greater debt investment opportunities, and very importantly at reducing risk or gearing levels. The business also has obviously the ability to establish some new vehicles, both in terms of that equity and the debt side of the business. In terms of the offering, $17 million is effectively the balance sheet against a $24 million market cap. So there's about a 70% NTA that sits in behind there. What are those assets? Made up of our holding in GDF, which is about 10 million units, or about $11 million on NTA. A $2 million debt receivable, cash proceeds out of the transaction, about $3 million, which is capable for investment further into GDF or other debt options, and there's some land on balance sheet as well. All those investments provide us with underpinned solid distributable income looking forward. And as I say, the primary equity investment is that 11% stake in GDF. If I just talk to GDF for a second, listed a year ago at $1. It's provided a 9% return over the FY16 year. We'll provide some guidance in the near future in terms of FY17. The portfolio was revalued recently, providing an increased NTA to $1.12 versus $1 issue price last year. So total shareholder return on an NTA basis of over 20% for GDF. There was a major shareholder in GDF. That increased NTA passes through to GCM, and this is something that's happened after the marketing of the float. What is GCM in conclusion? Provides exposure to an established property group, but at an early entry point, generating both operational investment returns from both the debt and equity side of the property activities, and management is substantially aligned to equity.